Elon Musk is preparing an initial public offering for SpaceX, targeting a valuation of $1.75 trillion. That single price tag is worth more than every American defense contractor combined. That valuation is larger than the combined market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks. Despite that record-breaking price, the company is currently losing $5 billion every year. In a rational market, who buys a company losing billions of dollars at the highest IPO valuation in human history? The buyer is you. Within a few weeks, your retirement account will become the biggest buyer of this stock, entirely without your consent, due to a quiet change in the financial system. SpaceX operates as a stack of 3 distinct businesses, starting with the orbital launch division. The rocket business generated roughly $4 billion in revenue last year. That figure represented only about a quarter of the company's total revenue, failing to provide a logical foundation for a $2 trillion valuation. The entity paying the bills is the second business, Starlink, a global satellite internet provider. Starlink has scaled to over 10 million active subscribers across 150 countries. Its profit margins expanded from 41% to 63% in just 2 years. But the profits generated by Starlink are being erased by a third business, an AI lab called xAI, which was merged into SpaceX at a $250 billion valuation. By March of this year, every single one of xAI's 11 co-founders had left the company. The asset is burning $1 billion a month, and the CEO admitted the entire lab needs to be rebuilt from scratch. This chart shows how xAI compares to its profitable competitors. OpenAI generates $24 billion annually against an $850 billion valuation. Anthropic makes $30 billion against a $400 billion valuation. xAI estimates just $1 billion in revenue, yet commands a $250 billion price tag. The inclusion of xAI turns the combined SpaceX entity into a $5 billion a year money pit. The math behind this IPO is broken. To find buyers for an unprofitable company at this price, the stock market infrastructure had to change. The Nasdaq 100 controls over $600 billion in passive investment capital, funds that trade automatically based on the index. Historically, new companies endured a mandatory 3-month waiting period on the public market. This gave investors time to discover a stock's actual market price before passive index funds were forced to buy in. This new fast entry protocol compresses the 3-month price discovery window to just 15 trading days. A second rule deleted the 10% public float requirement, accommodating SpaceX's 5% target. Finally, a hidden multiplier requires ETFs to treat that 5% float as 3 times larger. These aren't administrative updates. They are a calculated mechanism to bypass market logic. They ensure billions in automated demand flood into SpaceX immediately after it goes public. Insiders holding low-cost shares need an immediate wave of new cash to exit their positions at this $1.75 trillion peak. To find that cash, the company is dumping 30% of the offering onto retail investors, relying on their brand loyalty to the CEO to provide price stability. The rest of the capital will be systematically pulled from the 401ks of everyday people, enabled by those rigged Nasdaq inclusion rules. Passive investing is sold as a tool for convenience and diversification, but the exact mechanism that buys the index for you automatically is the same feature that forces you to buy whatever is added to it. The modern financial system has turned average retirement accounts into a captive audience. By engineering the rules of the index, the exchange has turned passive funds into guaranteed exit liquidity, forcing 401ks to absorb the overvalued shares of billionaire insiders.
Your retirement account? Hard-earned money is funneled into this trap. Headlines mask a devastating reality. We are living inside an illusion.
By the numbers, we are living through one of the richest moments in American history. The stock market has hit its 23rd record high, home prices are peaking, and the total net worth of the country has never been larger. But down on the ground, consumer sentiment toward the economy has crashed. How people feel about their finances has fallen lower than the early 80s recession. It is even lower than the devastation of the 2008 global financial crisis. And it is even lower than during the peak of the pandemic lockdowns. You can see this disconnect clearly inside the most boring account in America. The average 401k balance just hit a record high of over $160,000. Yet in that exact same year, the number of people cashing those accounts out early and paying the penalty tripled. People are raiding their own retirement funds purely out of necessity. Over a third of these hardship withdrawals were made to avoid eviction or foreclosure. Another huge chunk went to medical expenses, and the rest to cover tuition. This raises a fundamental question about the current era. How can the data show a booming economy while millions of individuals living inside it are sitting on the brink of financial collapse? The answer lies in how wealth is actually distributed. When the stock market climbs and creates trillions of dollars in value, that money doesn't fall on the country evenly like rain. It lands in specific accounts belonging to specific people. This stock distribution graphic paints a clear picture. The top 1%, 1.3 million households, owns over half. The top 10% hoards 87%. Compare that to the bottom half. Those 67 million households share a near invisible 1%. When translated into real dollars, the scale of this divide becomes impossible to ignore. Take a recent 16% market return. For the bottom half of America, that boom generated a paper gain of about $2,000. But for the top 10%, that exact same 16% return handed them a massive $96,000 gain in a single year. We are told market participation has been democratized because many people have a small 401k, but the actual dollars haven't been. Without significant assets, those record-high headlines you scroll past aren't actually happening to you. Looking at this comparison of recent economic data, you can see the reality of the average consumer's income. Average hourly earnings grew by about 3.6%, but over that same stretch, inflation rose 3.8%. That means the raise gets eaten by inflation before it ever lands in your bank account. Because of this, the highest percentage of Americans in 20 years cite high cost of living as their biggest financial problem. This brings us to a glaring math problem. If real wages are effectively down, where is the money fueling strong consumer spending coming from? It's coming from debt. Specifically, what economists are now calling survival debt. Americans are carrying about $1.25 trillion in credit card debt at an average punishing interest rate of around 23%. 1/3 of people carrying this debt cite day-to-day expenses as their primary reason for borrowing. They're financing basic survival rather than chasing rewards or financing vacations. And the borrowing goes well beyond credit cards. Over 90 million Americans use buy now, pay later apps to split purchases into delayed payments. Originally, these were used for big-ticket items like furniture. Today, 1/4 of the people using these apps are actively financing their weekly grocery runs just to feed their families. When you tally up all this borrowing, it leads to a devastating final metric. The personal savings rate for the bottom 65 million households has officially fallen below zero. The bottom half of America is spending more than they bring in after taxes. They are running a net loss every single month, completely draining their future in order to survive the present. For years, economists used specific models to describe this kind of wealth divide. Here is the classic K-shaped recovery model, designed to show winners on the top arm and losers on the bottom. But that geometry doesn't capture the modern US economy anymore. To see the true shape of our fractured class system, you have to draw an E. The top bar is the ownership class. Because their wealth is parked in stocks and real estate, and both have been on an absolute tear, this top 10% has watched their net worth explode, pulling completely away from the rest of the country. The bottom bar is the 67 million households trapped on the floor. With negative savings and only 1% of the market's assets, they don't benefit when asset prices inflate. They just absorb the cost, forced to finance their basic groceries. And that middle bar represents the vanishing middle class. Their financial breathing room is getting thinner by the day. We can see it in consumer data as they abandon premium lifestyles and migrate toward discount warehouse survival. When you look at the entire board, the top 10% of households hold nearly 70% of the nation's total wealth, while the bottom half of the entire population fights over the remaining 2.5%. This is why the data and the lived experience are so disconnected. The economic metrics aren't lying. The economy is booming. But those charts no longer measure the health of the country as a whole. They only measure the wealth of the people who own it.